Hey guys, Joel Frank here, market analyst for YouTrading, and this is the midweek market update. We'll take a quick look across markets, talk about what's been going on pretty much on the week. So let's start, as we normally do, by looking at the US dollar. I've got the dollar index here, or the Dixie. These are 4-hour candlesticks, and you can see that we had a kind of subdued start to the week. Dollar kept heading lower. That's because since last Friday, the dollar has been hit by concerns about the Omicron variant of COVID, which the worry is, like, usually the dollar's a safe haven, so you'd think, oh, maybe that should support the dollar. But there's been a lot of hawkish expectations built into the dollar in the last couple of months with regards to the Fed tightening policy in 2022. So instead of the dollar strengthening on a safe haven bid, in response to the Omicron stuff, the dollar was weakening because people were going, hang on a second, if there's a new variant that's going to be really bad, well, then maybe the Fed's not going to be hiking interest rates. So that's why the dollar's been kind of generally weaker. We saw this blip on Tuesday where we went back from around 95.50, 100 points higher, pretty much above 96.50 momentarily. That was in response to comments from Fed Chair Jerome Powell, who was, he's actually speaking again today, but he's been doing this testimony in the US Congress, and he's been getting quizzed on the economy and all this kind of stuff. And he's used this platform to signal a policy change. Now, he said, first of all, he said the Fed is going to drop the word transitory to describe inflation, which is hawkish. His tone on the economy was very kind of hawkish, like labour market doing really well, inflation risks higher and rising, and inflation very high. He still does expect it to moderate, but he's put heavy emphasis on the fact that these inflation risks have risen. And then perhaps most importantly, he said that he thinks it would be appropriate to talk about speeding up the bank's QE taper at the December 15th meeting. So anyway, we saw this pop higher in the dollar, but the dollar quickly kind of reversed because long-term US bond yields, short-term US bond yields did pop higher on Powell's hawkishness, but longer-term yields didn't. And that could be because people are worried that if the Fed is going to continue with its tightening plans despite a new coronavirus variant threatening the economy, well, then maybe that's going to be damaging for the long-term growth prospects in the US and the long-term inflation prospects. So when you're looking at yields and their relationship to the dollar, you have to look at the whole yield curve. So net still kind of been a negative because of Omicron at the moment. Those fears are going to have to subside about Omicron, and we're going to have to start having faith that the Fed's going to be hawkish and the US economy is going to be good for the next 10 years, and inflation's going to be, pretty high. That's when we can start seeing the dollar pushing back to recent highs. But for now, you can see I've kind of marked up this range, 95.50 to the downside, 96.50 to the upside. We'll probably stick to this for now. Moving on, S&P 500, it's been a bit choppy as well. Mostly it's been heading lower since Friday. This drop here, that was the Omicron drop. But you can see that we have had a little break of this downtrend, which could, in my opinion, open the door to a move higher towards these highs here in the 4,670 area, which also coincides with the 21-day moving average. So, provided the Omicron-related news isn't bad and Fed Chair Powell isn't even more hawkish than he's already been, that would kind of make sense. Finally, crude oil. Things are still not looking good for crude oil. Obviously, just like with the other asset classes, the big decline came as a result of Omicron. And we're now waiting to see what OPEC Plus are going to do. They're probably going to halt their output hikes because Omicron means travel restrictions, which means lower jet fuel demand. So oil has not responded well to any of this, and it's actually now below its 200-day moving average. You can see its 200-day moving average here in blue. That's around $70 per barrel, so that could continue to cap the price action. So unless OPEC really deliver with, output cuts potentially, then obviously we could break higher. But in the absence of that, I think we've still potentially got a bit of a negative bias, unless the Omicron news becomes really good, in which case we can shoot all the way back up. But anyway, in terms of the rest of the week, it's mainly around Omicron news, of course. What's the transmissibility? What's the resistance to vaccines? And what is the severity of illness when you actually get infected? We're still not sure about any of these, and we might not know until, weeks. But we're going to get the data trickling in, and markets will react to that. But then we've also got some US data, jobs data on Friday, should be strong. ADP data today was strong. ISM data today, manufacturing PMI was strong. We got the services PMI tomorrow. But like I say, those are probably just going to be strong and not really going to change the narrative too much. But anyway, guys, hope you enjoyed the video, and I'll see you all in the next one.